In this video, we are going to talk about the monthly time frame because the higher time frame is more reliable and holds more information. And in this video, I am going to explain how you can use the monthly time frame in your trading. So let's get into it. So I'm going to keep this simple, but at the same time, go a little deeper so you actually understand how powerful the monthly time frame can be, even if you're a scalper or a day trader, because the truth is you're not using the monthly for entries, but you are using it for direction. And that alone can completely change how you approach your trades. Most of you guys are not taking trades on the monthly, you're not holding positions for months. You're in and out within the day or within a few days. So there's no point overcomplicating it. But what the monthly does is it tells you where price is likely to deliver over time. It gives you that higher time frame draw on liquidity. So instead of thinking, where do I enter? On the monthly, you should be thinking, where is price trying to go? Now, if you look at the charts, one thing becomes very clear. Price hasn't really had a proper retracement phase in a long time on the monthly time frame. It's been very one-sided. And whenever you see that kind of behavior, you should naturally expect some form of rebalancing or retracement at some point. So now the next logical question becomes, where could price retrace to? And this is where we start identifying our higher time frame PD arrays. You can clearly see that June 2025 monthly fair value gap sitting there, completely unfilled. And that alone becomes a very strong draw on liquidity, because inefficiencies like that tend to get filled over time. Now yes, there is also the May gap below, and technically price could go there as well, but the key thing here is you don't predict, you don't force a bias, you simply react to what the market is showing. So for now, my main focus is that June gap, and if price shows more weakness, then I can start considering deeper targets. But I don't need to think that far ahead yet. Now here's where it gets even more interesting, because when you drop down to the daily time frame, you start seeing confirmation of that higher time frame idea. Price has been consistently respecting bearish PD arrays, especially inverse new week opening gaps. Every time price tries to push higher into these levels, it fails. Candles struggle to close above them, and instead you get rejection and continuation to the downside. This is not random behavior. This is showing you intent. This is showing you that the market is willing to go lower. And then if you look below current price, what do you see? You see very clean, very obvious relative equal lows. And this is something you already understand from lower time frames. Equal highs and equal lows are liquidity. They are targets. So the same concept applies here, just on a larger scale. This is what we mean by the fractal nature of price. The same patterns repeat across all time frames. So now when you combine everything together, you have a clear narrative on the monthly. You have a draw on liquidity in the form of that unfilled fair value gap on the daily. You have confirmation through bearish PD array reactions and below price. You have clean sell-side liquidity resting at those equal lows. So naturally, the expectation becomes that price is likely to move lower and take those lows, possibly into July or around that time frame. Now, the most important part is how this actually helps you in your day-to-day trading. Because again, you're not entering on the monthly, but you are using it to guide your decisions. For example, if you're trading intraday and you get a short setup from a premium level, now you have the confidence to hold that trade longer, because you know there is higher time frame liquidity below that price is likely to target. Instead of taking quick profits or second-guessing your trade, you can align it with the bigger picture. And another key thing is alignment. When your lower time frame bias, your daily bias, and your monthly bias all align in the same direction, that's where your highest probability trades come from. That's when things feel easy, because you're not fighting the market, you're moving with it. So even though the monthly might seem useless at first for scalpers, it actually plays a huge role in giving you direction, confidence, and clarity. And the best part is you can apply this exact same process on any pair. Just go to the monthly, identify the major inefficiencies and liquidity, understand where price is likely to deliver, and then drop down to your lower time frames and execute based on that narrative. That's how you combine higher time frame context with lower time frame precision, and that's what really levels up your trading. So that's how you actually use the monthly time frame the right way. Not for entries, not for overcomplicating your charts, but simply to understand where price is likely to go once you start thinking in terms of draw on liquidity instead of just entries. Your whole perspective on the market begins to change. You stop forcing trades, you stop getting confused in lower time frame noise, and you start aligning yourself with the bigger picture. And when your higher time frame bias aligns with your daily and intraday setups, that's where trading becomes much more smooth and much more consistent. So keep it simple. Use the monthly for direction and execute on the lower time frames with precision. If you found this helpful, make sure to like and subscribe, and I'll see you in the next one.